coming up on Retirement Today with April Roberts.
So with an immediate annuity, one downside is that you lose control of your money. A positive side is that you have income that continues for however long you've chosen. We find that 95% of the time, the investor does not realize what they're paying in fees. Now, we all know that everyone has to get paid, right? But the point is, you have to understand how much you're paying them so you can determine if it's worth it or not. It's really that simple.
The logic behind it is simply the IRS wants to get your tax money out of that money before you leave this earth.
The biggest problem is that people have a relationship with their advisor who's maybe helped them grow their assets, but I think it takes a different skill set to help you distribute your assets.
And now the host of Retirement Today, April Roberts.
Thanks for joining us today. We know that your time is valuable, so we have designed 30 minutes of action-packed information specifically for you and your retirement. Retirement Today starts right here, right now.
Oh boy, do we have a great topic today to talk about. Mutual funds. So much information, so much misinformation out there. So we've got a great publication that we want to tell everyone about. And look who's on the cover of this one. Awesome. Hey, listen, this one is called A Close-Up Look at the Mutual Fund Industry. 8 things you may not know about mutual funds. The good, the bad, and the fine print. So we're going to go in today and we're going to talk about this. And, you know, before we get started, Paul, would you do me a favor? I don't need a long explanation, but let's just do the short explanation of what is a mutual fund.
A mutual fund is simply a conglomerate of a bunch of investors. They think of it as a pot of money, and they're putting money in the pot. And the pot manager then goes out and buys stocks, bonds, whatever type mutual fund it is. Now, as a mutual fund investor, you own a share of that pot. You do not own the entire pot. You don't own the things in the pot, such as stocks. You're a mutual fund share. So things in the pot, we'll discuss a little later, could be sold at a profit or a loss, and it's up to managers to make profits for you. However, about 83% of them underperform the S&P index. So we think there's some use to that in your portfolio, possibly, according to where you are, at what stage of life you're in.
Well, this is why we're doing the good, the bad, and the fine print right now. In fact, at the break we were talking about, because we were reading through the publication here, and it said that they were professionally managed, and you kind of gave me a little bit of snicker talking about, hey, most of them are underperforming according to that study. So are they in fact professionally managed? But I'm going to move on right now, and I'm probably going to talk about the number one thing we need to talk about when we address mutual funds, and that is expenses can be higher than you think, April, right?
Absolutely, Mark. So when a new prospective client comes in to visit with us, what we do for their second meeting is a risk and fee analysis, especially if they have mutual funds or variable annuities, because we find that 95% of the time, the investor does not realize what they're paying in fees. Now, we all know that everyone has to get paid, right? But the point is, you have to understand how much you're paying them so you can determine if it's worth it or not. It's really that simple. And I think the average mutual fund runs 2 to 3% in expenses, and that's shocking to most investors.
And won't that be sometimes as well that not only do you have that 2 to 3%, but there could also be a management fee from your advisor on top of that, making it 3 to 4% possibly.
Absolutely. So normally your advisor's fee is declared on your statement. So that's easy to see. The fees in the mutual fund, not so easy to find.
And you know, again, getting back to the underperforming piece, I think people don't mind paying a fee if they have good performance or above average performance. But if in fact that study is correct, which we're going to of course assume that it is, we're paying for a lot for an underperforming product 83% of the time. Paul, my next question is for you, and it's Mutual funds can be tax inefficient. What does that mean?
Basically, you don't own the transactions, as I said earlier, in the mutual fund. So, for example, we have what you call phantom income. Everybody knows what phantom means, but phantom income is basically income that's reported on your 1099 that you pay taxes on your tax return, but you never receive the profit. Okay. For example, they could have some stock in a mutual fund with an old lower basis that the fund's kind of lacking, and they can sell it off to put a bunch of profit in there, at once, because they have to report all that by December 15th every year. You could get in prior to that and actually overall have gone down in your money. Your 100,000 is going to be worth 88 or 92. In addition to that, you lost money, but you get a 1099 at the end of the year and you pay taxes. It's kind of a double whammy. It's just one of the mechanics of the mutual fund called phantom income.
And I got two more questions before we head out to the break, and I'll start with you, April, on it. And where is the time and place for mutual funds? They're very, very popular. And a lot of people have them. Where is the right time and place for most, not all, for most investors?
Great question, Mark. So in my opinion, most people who are now retiring, most of the baby boomers, started really earning money in the 1990s. And we all remember the 90s, right? You didn't need advisors like Dad and I. You can make money no matter what you did. At this point, they're high income earners and they're told to put away money in their 401k. It's a very convenient way. Well, what does their 401k have most of the time? It has mutual funds. So people became very comfortable with investing in mutual funds and really didn't think much further than that. They thought, by investing in mutual funds, I'm diversified, which, interestingly enough, Mark, I find that if you have a portfolio full of mutual funds, and people are shocked to see this in the office, right, Dad?
Correct.
We'll show them their top stocks, and they own the same stock in 5 to 6 different mutual funds. So not only are they tax inefficient, but they're inefficient way of investing, in our opinion.
I'll tell you something. We've shared a lot of publications with the general public, and this is one. If you're a pre-retiree or retiree, you've got to have this. And it's the 8 things you may not know about mutual funds, the good, the bad, and the fine print. April, Paul from Roberts Wealth Management, thank you so much. Everyone stick around. We got a lot of great stuff to come. You're watching Retirement Today with April Roberts, because you deserve better.
Having no clear retirement plan is a mistake I see a lot in my financial planning office when I meet with someone new. It is extremely rare that someone comes in and has a clearly defined income plan for his or her retirement. One way you will be able to get a clearly defined retirement income plan is to talk to an independent financial advisor who specializes in retirement planning. Not someone who is specialized in getting you to retirement, but someone who is dedicated to getting you through retirement. If you don't have a clear retirement plan, then be one of the first 5 callers and you will receive a free complete planning review. There is no obligation and no cost if you have at least $250,000 saved for retirement. Here's what you will receive: a free report to sort through your current advisor's cost, a tailored plan to guard your investments, tax analysis to reduce liability and increase cash flow, and a custom income plan to boost retirement. Plus, you'll receive a budget assessment to help manage your cash flow. So call now for your free, no obligation financial review.
You're on the back 9 heading for the clubhouse. Your dreams of spending time with family and enjoying retirement are just within reach. What happens if you end up in the rough? In these uncertain times, it's crucial to be prepared with sound advice. Roberts Wealth Management is one of the premier retirement income planning firms in Texas. For a complimentary consultation, call 713-322-6600. Roberts Wealth Management, helping you create a winning strategy.
You're watching Retirement Today with April Roberts, because you deserve better. Hi, and welcome to this week's edition of AskAprilRoberts.com, where you, the general public, get to send in your questions, and we have them answered for you right here on the show. We have a very special guest with us today, and Paul Roberts is with us instead of April. Paul, thanks for joining us.
I'm glad you clarified that.
That's
Thank
right.
you.
And I think people would know right off the way that you're not April.
I'm
You're in
not
fact
April.
April's father. Again,
That's
total pleasure
correct.
to have you with us today.
Thank you.
Our first question is from David in League City, and he writes, I don't understand why the government is forcing me to take my money out of my IRA when I don't need it, simply because I've reached a certain age. Why is this happening?
It's the answer is pretty simple, but there's some solutions, David. I'd love to go over with you. Number one is it's the law under IRS code. It has been the law for a long, long time. Okay, and it is basically the logic behind it is simply the IRS wants to get your tax money out of that money before you leave this earth. Okay, so that's one way they could do it. That requirement is about 3.65% of your first year that you reach 70 and a half, or the year after you reach 70 and a half, okay? Now, what can we do about it if it so happens that this is money you do not need in retirement? There's a couple strategies you can do. One of them involves some life insurance, and one of them involves Roth conversion. I'm sure you're familiar with that and have heard and read about it and all. There's some alternatives to the Roth conversion, though. You cannot be not Roth. So what you don't want to do is you don't have to take the RMD, or required minimum distribution, if it's a Roth. The other product is our solution. It could be built up in life insurance product, and you're simply moving money from that taxable bucket to bucket C, the tax-free bucket, okay? So that would be, we do a lot of those type solutions there.
So it's all part of the overall thing that you're going to have to do it. This is the sort of thing where it seemed to be, they need to sit down with an advisor here, because if they've got this type of question, I'm sure there are more questions about that. So I thank you so much for your question. If you'd like to have your question answered here on the show, it's super simple. Just go to askaprilroberts.com, submit your question, and it might be answered by April, or you might have April's dad answering the question. Thanks so much for being with us today.
Thank you.
Stick around. We got a lot of great stuff to come. You're watching Retirement Today with April Roberts, because you deserve better.
Life, a series of moments. A touch, a look, a laugh. Successful people. It might not be superior imagination. It just might be superior retirement planning. Imagine what's next. Plan today, own tomorrow.
Call Roberts Wealth Management, 713-322-6600.
You're watching Retirement Today with April Roberts, because you deserve better. Hi, and welcome to this week's Retirement True or False. I am accompanied, as usual, by April Roberts and Paul Roberts of Roberts Wealth Management. Guys, how we doing today?
Doing great. How about you?
Awesome, thank you. Paul, my first question is for you. And the question is, you don't need to use a different strategy when you move from the accumulation stage of your retirement to the distribution stage of your retirement. True or false?
False. Very false. Because they're so different. The problem in the financial world when people retire, they keep investing like when they were accumulating money. They took a little more risk. Now that they're retired, they're in the distribution phase. That's where you can really mess up your retirement, because not of just bad investments, because of rules and regulations and all the sort. So it's very important to change your strategy during retirement.
You know, and it seems to me like, too, and having worked with a lot of advisors like you guys across the country, so many people are, in fact, using that same strategy, April, that they did in the accumulation phase, and they've been told that's okay. That's what you should be doing now, right?
I agree, Mark. And I think the biggest problem is that people have a relationship with their advisor who's maybe helped them grow their assets. But I think it takes a different skill set to help you distribute your assets. And the majority of people who come to see us are worried about running out of money because they don't have a retirement income plan. So I think if you're retiring or planning to retire, it's so important to make sure you're working with a firm who's going to set up that retirement income plan for you.
April, my next question is for you, and it is, mutual funds could have very heavy fees associated with them. True or false?
Well, Mark, that's true and false. There are some lower cost mutual funds famous out there, but I think that most investors don't realize that their mutual fund costs could range from 0.5% up to 5% of cost. And that's because the mutual funds are not required to disclose all of the fees and costs inherent in them.
Well, let me ask you this, Paul. When is the right time to have mutual funds, and is there a right time in an investor's career and their journey to have mutual funds?
There could possibly be a right time in your accumulation stage with part of your money, not all your money. The problem is I see too many people that come from a place where they have all their money in mutual funds, and that's definitely a no-no that good advisors will tell you, trusted advisors, okay?
All right, my next question is for you, Paul, and that question is, most investors are prepared for the next stock market correction, true or false?
That's one of those triple false, because most people think they are prepared, they don't understand risk, and they don't understand the risks they're at. And more people for the first time in their life find out about their true risk when we do the risk audit for them, basically on where they are. Okay.
So this is great because there is something that can in fact be done, April, to mitigate that type of situation again in the future, if in fact there is that type of correction in the future.
Absolutely, Mark. Historically, we've averaged that type of correction every 5 years. As we know, we're well past 5 years since 2008. However, if you build a solid fundamental retirement income plan where you have foundational money, lower risk money, and higher risk money, then you're not as subject to decline as you were back in 2008 when we were all in the market.
April, Paul, thanks so much. Stick around. We got a lot of great stuff to come. You're watching Retirement Today with April Roberts, because you deserve better.
It's your retirement. How will you live it? How will you be remembered?
Will you be able to take me on vacation? Will you be there for my ball games? Will you teach me your values? Will you be able to play with me? Oh, help me go to college. How will I remember you?
Have the retirement you dream about. AskAprilRoberts.com.
Having no clear retirement plan is a mistake I see a lot in my financial planning office when I meet with someone new. It is extremely rare that someone comes in and has a clearly defined income plan for his or her retirement. One way you will be able to get a clearly defined retirement income plan is to talk to an independent financial advisor who specializes in retirement planning. Not someone who is specialized in getting you to retirement, but someone who is dedicated to getting you through retirement. If you don't have a clear retirement plan, then be one of the first 5 callers and you will receive a free complete planning review. There is no obligation and no cost if you have at least $250,000 saved for retirement. Here's what you will receive: a free report to sort through your current advisor's cost, a tailored plan to guard your investments, tax analysis to reduce liability and increase cash flow, and a custom income plan to boost retirement. Plus, you'll receive a budget assessment to help manage your cash flow. So call now for your free, no obligation financial review.
You're watching Retirement Today with April Roberts, because you deserve better.
Our topic for today is Annuities 101. I can't tell you how often people come into our office and tell me, April, I hate annuities. My next question is, well, that's great, but what type of annuity are you talking about? In general, there are 4 types of annuities, and what I find is helpful is to educate my clients about these types of annuities. Because as with anything, there are good and bad points. So I find that often people confuse good points from one type of annuity with bad points from another type of annuity. Today, what I'd like to do is go through the 4 major types of annuities with you so that you can understand a little bit better and decide if they might be right for you or not. The first type of annuity is an immediate annuity. Here's how an immediate annuity works. You give the life insurance company money, let's say $100,000 you invest in, And immediately, they give you a source of income. Now, you can take this income in a number of ways. You can take it over your lifetime and your spouse's lifetime. You can also take it for 5 years, 10 years, 20 years. There's a number of different ways. But what you can't do is call the company back up and say, hey, guess what? I'd really like my $100,000 back. So with an immediate annuity, one downside is that you lose control of your money. A positive side is that you have income that continues for however long you've chosen. The next three types of annuities, fixed, variable, and fixed indexed, or also known as hybrid annuities, are deferred annuities. All right? And what that means is if you give them an amount of money, it's going to stay there and grow for a period of time, and then you're either going to move the money or you're going to turn on an income source instead of taking it immediately like the first type. So the next type of annuity, a fixed annuity, gives you a set interest rate, kind of like a CD in the bank. You can decide, do I want 1, 3, 5, or 10-year time commitment, and obviously the longer time commitment you choose, the higher the rate they pay you. So let's say that you walked in and just wanted a 5-year fixed annuity that's going to pay you 3% per year. That's exactly how these annuities work. So you'll get 3% of interest each year for the 5 years. This interest is compounded, and the other way it differs from a CD is it's tax deferred. So as you earn the interest, you don't have to pay taxes on it. That's a fixed annuity, pretty simple. Now the next two get a little more complicated. The next one is called a variable annuity. And like I said, there are pros and cons to every type. With a variable annuity, you're basically investing your money in mutual funds, so your account can go up and down with the fluctuations in the stock or bond market. The way that a variable annuity overcomes this for retirees is that it puts a rider on there. So you can either have an income rider or you could have a death benefit rider. Now, one thing you should know is anytime you see the term rider, it means you're probably paying a fee for this benefit. So we want to weigh if that benefit's right for you or not, since we're paying a fee for it. So a couple of things I don't love about variable annuities for my clients, because about half of my clients are retired and the other half are retiring within the next 10 years, is this volatility. So most of my clients share with me is that as they get older, they want less risk in their investments. So we would prefer less risk than a variable annuity. On the flip side, you could earn a lot of money in a variable annuity. That's a good part. Another thing I don't love about variable annuities are the fees. So the fees run about 3 to 5% a year based on how many of these riders you add on to the account. So what happens to me a lot is a client walks in and says, hey, I don't love annuities because I lose control of my money, and also they have high fees. Well, in reality, in this one you lose control, in this one you have high fees. So we need to know the difference. The final type of annuity is called a fixed indexed annuity. And here's how it works. As the market goes up and down, you're going to earn interest based on the movement of the index. So when the market goes up, we can earn some money. When the market goes down, we stay the same. When the market goes up, we'll earn money. And when the market goes down, we're going to stay the same. As with any type of annuity, this annuity has catches. Number one, we're going to make a time commitment. And number two, we're not going to get all of the market gains. All right? In this type of annuity, we can also add these riders, but here, it's probably going to run us about 1% in fees. So at the end of the day, when you're talking about I hate annuities or I love annuities, be sure you're crystal clear on what type of annuity you're talking about. If you have any questions or would like more information, please go to our website or give us a call in the office.
You're watching Retirement Today with April Roberts, because you deserve better.
You're on the back nine heading for the clubhouse. Your dreams of spending time with family and enjoying retirement are just within reach. What happens if you end up in the rough? In these uncertain times, it's crucial to be prepared with sound advice. Roberts Wealth Management is one of the premier retirement income planning firms in Texas. For a complimentary consultation, call 713-322-6600. Roberts Wealth Management, helping you create a winning strategy.
Remember when life was simpler? When things didn't move quite so fast, and the world didn't seem so complex? Remember that? We do. And as the world around us has continued to speed up, becoming more complicated, and still a bit uncertain, we have managed to keep things simple, providing sound, easy-to-understand financial advice and customized roadmaps for the road ahead, from tax reduction strategies, investment advice, and guaranteed retirement income you cannot outlive, backed by the claims-paying ability of insurance companies. We can be your single point of contact, a single call, a voice you recognize well, and a partner who can be by your side for the entire journey. We can't stop the world around us, but we can help ensure you're prepared for what's to come. To schedule a no-obligation meeting, simply contact us today.
You're watching Retirement Today with April Roberts, because you deserve better.
Thanks for joining us today. If you have any questions, feel free to visit our website or give us a call at the office. And remember, a retirement income plan is the start to a happy and smart retirement. Have a wonderful day, and we'll see you next week.
Life, a series of moments. A touch, a look, a laugh. Successful people. It might not be superior imagination. It just might be superior retirement planning. Imagine what's next. Plan today, own tomorrow.
Call Roberts Wealth Management, 713-322-6600.
Having no clear retirement plan is a mistake I see a lot in my financial planning office when I meet with someone new. It is extremely rare that someone comes in and has a clearly defined income plan for his or her retirement. One way you will be able to get a clearly defined retirement income plan is to talk to an independent financial advisor who specializes in retirement planning. Not someone who is specialized in getting you to retirement, but someone who is dedicated to getting you through retirement. If you don't have a clear retirement plan, then be one of the first 5 callers and you will receive a free complete planning review. There is no obligation and no cost if you have at least $250,000 saved for retirement. Here's what you will receive: a free report to sort through your current advisor's cost, a tailored plan to guard your investments, tax analysis to reduce liability and increase cash flow, and a custom income plan to boost retirement. Plus, you'll receive a budget assessment to help manage your cash flow. So call now for your free, no obligation financial review.